Good afternoon, everybody on with us today. It's so great to be here with our friends at CAFL, our partners, with the great relationship that we have with the firm, with our CAFL staff, the team, and of course with all of the advisors that they work with and bring to us as well. So it's an honor to be here with you. We frequently get to present for you with CAFL on your webinars, and it's always a privilege to do so. And we're happy to be here again today. And today, we know the month of November. This is a hot topic all year round, really ongoing, but it's even hotter now. We are now in November, which is Long-Term Care Awareness Month. And so very appropriately, our topic today is going to be centered around living benefits that include long-term care in that. And so it's our privilege to be here with you today to talk about that, such an important topic. So many solutions to provide clients, so many opportunities for us to help clients, which is really what this is all about. So with that, we are really lucky today, and I always feel lucky to be with her, we have with us today Jennifer White. Jennifer is our Director of Living Benefits at John Hancock. Not only is Jennifer a product expert and knows all the products, she is really a highly respected national living benefits expert, is highly thought of in the industry and a thought leader. So we are very proud to have her with us today, and she brings so much value to the table for us, and she will for you today with her presentation. So with that, Jen, take it away and let's go.
Thanks, John. What a nice intro. Thank you so much. All right, I'm going to go ahead and get my presentation going and just give me the A-OK that you can see it. Hopefully it looks good on your end. Or no, am I not showing you yet? Are you able to see the presentation?
Not yet.
Okay, hold please, just 1 second. And let's do this. Let me try again.
There. Oh, looks like it's coming.
Okay, now we just
there we go.
Sometimes my mouse is a little wonky and either it doesn't hit it or it flies around my screen and then I can't find it. So I think we should be good now. Okay, great. Thank you very much. Okay, and thank you for having me. I echo John's thanks in that nice introduction that he gave me. So as he mentioned, we are in the middle of Long-Term Care Awareness Month, which I would argue is probably one of the most important parts of the year. With that being said, I've had a lot of people ask me over the years, why do they put LTC Awareness Month at year end when everybody's trying to close business, right? Like why do we want to focus on this when we're trying to get our year end wrap up? And I tell them all the time, well, it's very strategically placed in November, right? Which comes right before the holiday season. And what happens at the holiday season? You have maybe kids and family members getting together to spend some time, and maybe they realize mom and dad might not look as steady on their feet as they once did. Maybe they're forgetting those things that they might have recalled last year at this time. And they just start having a little bit of a different look at their loved ones. And there's a reason why I think insurance companies tend to receive their highest number of claims in January is for this very reason. Like families are getting together, they see that the parents might need some help. And then after the holidays, it tends to kind of hit the carriers, right, from that what seems to be an obvious need to the children. So November is very important as families start getting together. I think it's that awareness message of really maybe talking to clients, whether they're your younger clients, to have the conversation with parents, or even parents talking to their children. What are their plans for should they need some sort of care and services to keep them safe at home? So that's why it's in November. It's a very important subject. Before we actually get started on the long-term care portion, I just want to address kind of the way we look at our living benefits portfolio at John Hancock. And I know living benefits are really such an important part of the life insurance sale now. I think back when I started in long-term care insurance, we just had long-term care insurance, right? It was one product, one solution that was supposed to fit everybody. And now we have a variety of solutions, right? There's still long-term care insurance in the market, but now we have life insurance companies, annuity companies that are coming to market with different types of products that really can be tailored to meet different client needs, which I think is a very exciting time to be in this living benefit space, particularly though with John Hancock. As you probably know, you're aware of our Vitality Rider. And I think the way that I align our living benefits portfolio is that not only are we just trying to help customers live longer, healthier, better lives with Vitality, but the living benefit riders are what helps them afford to live longer, healthier, better lives, right? Because if you gotta be able to plan to live a long life, if you're going to, you need to be able to afford it. So I think that's where the living benefit riders come into play, particularly for us here at John Hancock. So you see the ones that we're going to address today. We're going to start with critical illness before we get into really the long-term care and chronic products. I like to spend a little bit of time on the critical illness rider because it is really important. And I think it is very intentional to protect a very specific stage of life. When we talk about being able to afford to live a long life, this is your client's peak accumulation years, right? When they're working, they're probably in their peak earning years. What if they suffered some sort of critical illness during that time? So think about things like a cancer, heart attack, or stroke diagnosis that might come during their peak earning years. And you look on the left-hand side, how would they continue to supplement those lost wages if they need to be out of work? Or even think about self-employed individuals running their own business. What if their treatment wasn't covered by their health insurance? What if they have non-medical expenses, right? What if they have the day-to-day lifestyle expenses they need to continue meeting, but they weren't earning an income or a reduced income? And then, of course, the biggest one when you talk about being able to afford to live a long life is how would they be able to continue making those financial contributions towards retirement, right? To be able to continue their savings plans, whether it's for children's college education or their own plans, right? How would they continue to be doing all those things should they be out of work or only participating in work for a limited time? So we've designed a critical illness rider that's a little bit different than what you would typically see on the market today. So our critical illness rider sits alongside the life insurance policy. So it's not an acceleration of the death benefit, which makes it very unique. We'll go into a little bit as to the why on that. But just to give you a bit of a high-level overview as to how this rider works and the value proposition it brings, this is just one slide. If you want more information, National Sales Support can certainly help you out with all of that. But the idea here is to really get you to think about how this rider could provide value and money at a time when it's needed the most. So the first thing it does is it provides a one-time lump sum income tax-free benefit if a client is diagnosed with a covered critical illness. And those critical illnesses are typically cancer, heart attack, and stroke. If you look at most critical illness claims or policies, those are probably 85% of what we're talking about when we talk about critical illness and critical illness insurance. But it also covers for other conditions like kidney failure, major organ failure, coronary artery bypass grafting, and paralysis. So there's other conditions that are covered as well. So this rider has to be added at issue. At issue, they choose either 10% or 25% of the policy's total face amount. And then that's what determines that separate benefit pool that lives alongside the life insurance policy. Okay. If somebody bought a large policy, say they bought a $20 million policy and they wanted to add the 25% critical illness rider, they can do that. We're just going to cap that benefit, that critical illness benefit, at that $250,000. So if somebody suffers one of those illnesses, let's say, for example, they develop invasive cancer, and they qualify for benefits under the policy, we're going to make that benefit payment, that one-time lump sum income tax-free benefit payment, and they would receive those benefit dollars, and their death benefit would remain intact. So why is that important? Well, one, if somebody's in their accumulation years, insurability is really important, right? If they took so much out of that death benefit and they needed it for purposes of providing for beneficiaries or even for long-term care, if they were using this policy for a few different areas of need, accelerating that death benefit so early would really cause a problem, right? And they might not be able to buy additional coverage. So the reason we designed this to really be alongside and not as an acceleration of the death benefit is to really preserve the policy and keep it intact for beneficiaries or for long-term care needs, which of course is a huge selling point on a lot of the John Hancock products. So again, it's that separate benefit pool. It's a unique thing to, I think, the industry. And so it's like your own little critical illness insurance policy that lives alongside your life insurance policy. And then most importantly, all of those questions on the left-hand side here, the money that's paid is a cash indemnity. So there's no restriction on how those benefit dollars are used. So you can take that $250,000 or $100,000, whatever they purchase, and use it to support day-to-day expenses, lifestyle expenses, supplement treatment that might not be covered by their health insurance, or continue those financial obligations, right? To be able to continue making those contributions for when they live a long, healthy life, right? So I think the key with critical illness is a lot of these conditions are now becoming recoverable, survivable, which is good news, treatable, but oftentimes there is going to be an expense that goes along with that. So that's kind of what this was designed to do, is really provide money during those peak earning years when a client may suffer one of these conditions where it could really disrupt their ability to be able to maintain their day-to-day expenses, but yet also save for the future. So if you want more on that, definitely give us a call at John Hancock and we could certainly explain more of the details. So now let's look at kind of what we're here to talk about today is our long-term care product portfolio. So some of them are long-term care, some of them are chronic illness. And I think a lot of people say, well, how do I know which rider when, right? Which is going to be the best one for my client? So that's what I really wanted to talk a little bit about today, because I think what's great is that we have a number of different solutions now, but how do I know which one is going to be the right one for my client, or can we offer some guidance around that? So even though we have 3 different solutions, they're all going to be triggered in the same way. So we try to keep it simple in that regard, right? So each one of the riders we're going to talk about, whether it's long-term care, chronic illness, or our accelerated death benefit for chronic illness, they're all triggered when somebody needs assistance with 2 activities of daily living expected to last 90 days, or they require supervision due to a cognitive impairment. So there is no permanency requirement on any of these products, right? The condition does not have to be expected to last the rest of their life. It's simply that 90-day expectation of need, which makes it long-term care or chronic illness. And then each of these riders have a 90 calendar day elimination period. So what that means is the day somebody is certified as chronically ill, as we just discussed, we're going to count 90 days from that certification. And on day 91, they would be eligible for benefits. So it's not tied to when they file a claim, when we approve a claim, whether or not they're receiving any types of care and services during the elimination period. It's strictly 90 calendar days from that written certification. So that's that one standard that's good with all 3 of these different riders we're going to talk about. So high level overview, I like to explain these different riders as it relates to taxes, because I think sometimes people think about reimbursement in a different way. They think about indemnity in a different way. So in its most basic sense, we're first going to walk through this, and then we're going to go into some of the details about more of how they get applied. So the first one is our long-term care rider. I think John Hancock was probably one of the first companies, if not the first company, to introduce an acceleration of the death benefit for long-term care. I think back in maybe 2000, 1999, or whatever it was. So this is your traditional reimbursement long-term care rider. It's going to pay for qualified long-term care expenses incurred. So what does that mean? When people think reimbursement, sometimes they think about the little old lady sitting at her table on hold with the insurance company, waiting to get reimbursed, and she's surrounded by all these receipts, right? And that really is not what reimbursement means. Reimbursement, in its most basic sense, means we are reimbursing for qualified long-term care expenses incurred. It doesn't mean somebody has to be surrounded by receipts and then submit invoices. So because we are reimbursing for qualified long-term care expenses incurred, it means those benefits are going to be received income tax-free. Okay, so that's going to be a little different than what we see with chronic illness. And we'll talk more about these in detail. With chronic illness, that's going to be a cash indemnity benefit payment. Now, the taxation here, it says the IRS basically tells you you can tap into that death benefit early if you have a qualifying event. In this case, it's being diagnosed as chronically ill. So now I could tap into my death benefit, and instead of using it because I'm going to reimburse or pay for qualified long-term care expenses, it's simply giving me money or giving me access to my death benefit early because I'm chronically ill, and therefore I'm able to get those benefits without any restriction on how they're spent. Okay, so the IRS says, okay, we'll give you access, but we're going to cap it at a certain amount because we don't know what you're doing with those dollars, right? So we're not going to give you unlimited tax-free benefit like we will with a product that's paying specifically for qualified long-term care services. So chronic illness, a little different, still going to pay when somebody's chronically ill, but it's tied to the illness as opposed to the care and services received. It's up to the per diem amount that the IRS says you can take from year to year on a tax favored basis without showing them how it was spent. So I think that's the difference between cash and reimbursement. And again, as I said, we'll talk a little bit more about this later. And then our last one is the accelerated death benefit for chronic illness rider. It's kind of a mouthful, but it was intentionally named this way, just so people really understand how it works. This is one of those back-end charge riders. It's also going to pay on a cash indemnity basis once somebody qualifies as chronically ill, but the charges and the benefit are going to be determined at that time of claim. And again, we'll talk about that. But again, because it's chronic illness rider, It's tied to the condition, not the care. So it's going to pay that cash indemnity benefit, which means it's going to be capped at what the IRS says you can take in the year that the benefits are accelerated. So I hope that gives a good baseline into what we're going to go into now. So we're going to take a look at each of these in a little bit more detail. So the first one is our straight up long-term care rider. I like to say this rider is for, somebody who's looking to receive the most amount of income tax-free protection for the overall lowest cost, right? So it's reimbursement that helps keep the overall cost down. And because it's reimbursement, it allows us to pay benefits that are in excess of that IRS per diem limit on a tax-favored basis. So I like to think about this as really a nice pairing for very high net worth individuals. So people, the ones that you hear, the ones who can buy a nursing home, right? These are the ones that, by the nature of somebody saying that, it means, they can afford to, pay for long-term care out of pocket. But why would they when they could use the leverage from an insurance policy to get up to $50,000 on a tax-favored basis, right? Income tax-free benefits to pay for those care costs, as opposed to having to liquidate assets, reallocate retirement income, or, liquidate qualified funds, whatever they're going to have to do, or even earmark an asset that's going to be used to pay dollar for dollar. Why do that if you can offer that leverage on a tax-favored basis? So I love a straight-up reimbursement long-term care rider for high net worth individuals for that very reason. Up to $50,000, income tax-free, even when those expenses exceed the IRS per diem limit. So other thing to know is that these riders all need to be included at time of issue. And so with the LTC rider, whatever you add at the time you purchase the policy, whether it's 1, 2, or 4% of that death benefit, is going to determine your MMBA, your maximum monthly benefit amount. So you know exactly how much benefit you're going to have when you buy the policy. Unlike some, products that are going to be tied to the IRS limit, which is going to change from year to year. So it offers that real predictability factor. It's considered qualified long-term care insurance under 7702B of the tax code. Now, why is that important? Well, depending upon the type of products, not with this rider, but certain products that fall under this tax code have certain tax favor treatment that might have to do with premium deductibility. We'll talk a little bit about that later. But for purposes of our LTC rider and other LTC riders on the market, if they're considered long-term care insurance, they enjoy all that same favorable tax treatment that the IRS gives to those products. For people on the call who may or may not know what happened in the state of Washington over the past couple of years, they introduced a first of its kind state-funded long-term care insurance program for Washingtonians. So what that means is people who work in the state of Washington are now contributing a payroll tax. It is funding a state long-term care program. And then those who pay into it will be eligible for long-term care benefits through what's called WACARES, which is the program. There were a lot of people who determined that paying the payroll tax was going to be more expensive than owning their own long-term care insurance. And long-term care insurance would be less costly and provide more benefits than what they're going to get through WACARES, which was $36,500, a lifetime benefit, which isn't much. So what WACARES said was, if you buy your own long-term care insurance during this window of time, we'll let you request an exemption from our program. So what happened is we saw the biggest fire sale on long-term care insurance. I'm going to include long-term care insurance as far as standalone, hybrid products, those extension of benefits policies, in long-term care riders just like ours, because it qualified as long-term care insurance for purposes of being able to purchase it and then request an exemption from the WACARES program. So what that means is, under 7702B, we know what is long-term care insurance. And if it doesn't qualify, we know what is not long-term care insurance. So I think what we saw from Washington is it really drew this line in the sand between what is and what isn't considered long-term care insurance. So people who bought a chronic illness rider, like the one we're going to talk about next, was not eligible to request an exemption from the program. Now, they all have a place, but I think a lot of producers who may not have had their health or LTC certification, right, which is why they're only selling chronic illness products, were caught off guard when their clients called and said, hey, wait a minute, my state is implementing this payroll tax. Can I request an exemption? I bought long-term care insurance, didn't I? Or bought long-term care rider on my policy. They said, well, no, you bought a chronic illness rider. Well, I thought I bought long-term care insurance. Well, it does the same thing, but it's just called chronic illness. Can I or can I not request an exemption from the payroll tax? So that's where I think a lot of producers found themselves. And if their answer is, well, I can only sell chronic illness because I only have a life license, that might not be a good enough answer. So I've been, kind of challenging people over the years after we saw what happened in Washington to make sure when you're doing the product selection with your clients, you're making the recommendation based on what their needs are, not based on your limited ability to sell these products, right? And I understand the certifications that can sometimes be a challenge, but just think about getting that call from a client if their state were to follow something like we saw in the state of Washington. While we don't know what's going to happen, certainly at some point they might decide chronic illness riders can qualify. We don't know, but I usually tell people if you're concerned about your state or being able to request an exemption from some sort of state program, going the LTC 7702B route is probably a good idea. Clients who are already in retirement, maybe they live in a state where they're never going to need or worry about a payroll tax, or clients who might be looking to get more flexibility out of the benefits and they doesn't matter to them. There's reasons why you might want to go the chronic illness route. But my challenge is just to say, make sure you think about the products that you're able to offer and that you're doing the right thing by your client. So who's the client here, right? They're primarily concerned about the risk of long-term care and being able to cover those costs. So that's kind of the primary driver, obviously, for adding a long-term care product. For people who really want to be able to stretch those benefits as long as possible, right? The nature of using a reimbursement design means that you only are accelerating what's needed to pay for long-term care costs, right? So you can actually stretch that benefit out longer to cover maybe an extended long-term care need. I already talked about the high net worth individuals, the predictability, and the state initiatives. The one I do want to mention too is if you think about single individuals or people who maybe don't have children or don't necessarily have that quarterback. What's nice about this product, I mentioned that you don't have to, the little old lady sitting surrounded by receipts, that you don't actually have to get reimbursed. What I mean by that is there's something called assignment of benefits. The nature of using a product that is directly aligned with paying benefits based on costs incurred means customers can assign benefits to their home health agency, their skilled nursing, wherever they are, their care provider. So what does that do? That takes the customer, even their family if they have one, out of that equation of having to manage benefit dollars. So because it's reimbursement and we're basing the benefits paid off costs incurred, I can have my home care agency deal with John Hancock, get the invoice, and then pay it directly. So it takes me out of the equation, right? So that little old lady with all the receipts doesn't have to happen. So I think that's the nature of reimbursement. When people think about it, reimbursement for costs incurred is not necessarily you have to be out of pocket. So think about it from that standpoint too. So that's kind of the landscape of a long-term care rider who might be a good customer for that. Now let's move on to our chronic illness rider. This is actually something that, when I first got back to John Hancock almost 9 years ago, and I was trying to talk to them about, we need an indemnity rider, and they told me, I don't know if that's ever going to be our market, but here we are. So this is John Hancock's really true first indemnity rider. Why did we go the chronic illness route, not the long-term care route? Well, for that very reason, I challenge people on this call. We know that there's a lot of people out there who only have a life license. They do not have an LTC certification. They don't have a health license. We wanted to put something in their hands to be able to offer John Hancock policyholders, right? Or John Hancock future policyholders, as we would hope. So we went this route, a 101G rider. You only need a life license to sell it. So that helps producers out tremendously, I understand. But the important thing here is that chronic illness is not long-term care insurance. Okay, so there's not going to be that 7702B status. You're going to access your death benefit early under 101G of the tax code. So it's a little different. Again, it's going to provide money when it's needed the most, absolutely. And it's going to provide the most flexible benefits because it's not only paid for qualified long-term care expenses. So you're going to get those benefit dollars. You can use them however they need to be used and however you see fit. But at the same time, somebody's going to need to manage them. So that's why sometimes it's important to understand that when you're putting money either into, direct deposit into a checking account or just mailing a check to a home, you just want to make sure somebody is able to manage those benefit dollars, right? So if you think about a single woman trying to age in place as best she can, maybe a reimbursement product might be better. But again, this is going to offer the most flexibility of those benefit dollars, right? So if you think about somebody who has a formalized plan where their child is actually going to take care of them, right? The child's going to quit their job. You hear this all the time. My daughter will take care of me. I tell people, if that's the case, let's get the daughter into the next meeting, or let's get the daughter on the phone to make sure she knows she's part of this plan, right? Because a lot of times my daughter's going to take care of me is that avoidance discussion, right? To just say, no. So that's why if it's a formalized plan, there is going to be an informal caregiver who's going to step in and actually provide this hands-on or supervisory care that's going to be needed. Then this at least provides an option to compensate them if they needed to quit their job, right? But again, making sure it's a formalized plan. The other thing, which I think is very unique to John Hancock, is the ability to pay all of those benefits outside the US, right? So there's a lot of customers who may decide to retire somewhere, more luxurious than the United States. I don't know, Belize sounds nice, Costa Rica, I hear about these things all the time. And the benefit can be paid outside the US without the need to come back to the US to recertify. So what does that mean? The customer would need to be certified as chronically ill by a licensed healthcare practitioner. And as long as they're US licensed, we can accept that as a written certification. So that could be done possibly, via webinar, via some sort of virtual assessment. And as long as that person is US licensed, who's making that determination, then we can take that as a licensed healthcare practitioner certification. So I think for people who are looking to retire overseas, this could be a tremendous added value to a policy to be able to get those benefit dollars paid out. Again, capped at that IRS per diem limit, which is, I think, something that's pretty unique. I know some riders are going to cap how much they'll pay outside the country, maybe take a haircut, right? If the benefits are being paid outside the country, it will be paid in US dollars. So hope that gives again, it's the most flexibility, I think, coming out of COVID, right? There was a lot of concern around people coming in and out of the home. Really, this provides that most control over how those benefit dollars are going to be used. And then the last one is our alphabet rider, right? The accelerated death benefit for chronic illness rider. And this is one of those riders that has a back end charge, right? So you're not going to pay a monthly charge for this rider. You're only going to pay for the rider when you use it. Well, why wouldn't everybody buy this, right? This obviously sounds like the best rider. Well, it depends. If somebody is concerned about having money available to pay for long-term care costs, right, and they can qualify for the long-term care rider or the chronic illness rider, this is probably not the best solution for them. If somebody is concerned about cash value accumulation, they're younger, they're planning for retirement, they're doing retirement income planning, why not add a rider that doesn't have a monthly charge onto that policy that really just gives them access to their death benefit should their needs change, right? They don't have to do anything. They're not paying for anything until they actually go to use it. So the problem is if somebody were to put this on their policy, say they're mostly concerned about paying long-term care costs, they're really focused on protection and this is their care need, their parent had Alzheimer's disease, they want to make sure they have something in place. The charges are taken out of the benefit payment at time of claim. So what's going to happen is the earlier somebody might want to accelerate those benefit dollars, say they get early onset Alzheimer's, like mom had, and they're 68, 69 years old, the earlier they access those benefits, the more costly it's going to be. So the charges are going to be determined at time of claim, and it's going to reduce the benefit otherwise payable. So yes, this has a place in the market, right? Like I just said, for people who are focused on cash value accumulation, what happens if during their early years, they do get early onset Alzheimer's, they suffer a stroke, they have something that happens to them, and now they can't qualify for a long-term care product or a chronic illness product. This might be the only type of product they have, right? Or somebody who is too high risk for one of these other products, they can maybe qualify and just add this to their policy, which is going to give them access to their death benefit on an income tax favored basis. So again, different planning needs, right? And I think that they all have their place. It's just making sure you're using and maybe recommending the right one based on what the client needs are, right? So think about, when Mark Berry and I did that presentation on, the long-term game of life, I think the example is a 35-year-old looking at, protection, a 35-year-old who's focused on cash value accumulation. Maybe they're saying, I'll get to my long-term care planning later. this at least is in a way ensuring their insurability to some degree, right? And giving them an option to help pay those care costs. So again, might be their only option, but if somebody's mainly focused on long-term care, chronic illness protection, probably one of the other two products would be a better route to go. Okay, and just to talk a little bit, John Hancock has been in the long-term care benefits market for a long time. We're probably one of the first few companies to have a long-term care insurance policy. It was, I think, a nursing home only policy probably back in 1987. But again, we've been paying long-term care benefits for over 30 years. We know what we're doing when it comes down to this. Look at that, $22.7 billion in long-term care benefits. Those are real benefit dollars going to help families when they need it the most. And we pay over $6 million a day. That takes a lot of experiences, and again, being able to offer a qualified long-term care rider, being able to do it on a reimbursement basis takes experience. Not every company can just jump in to do that, right? You have to build out a claims team. You need to adjudicate claims, which is why a lot of people have been, or a lot of carriers have been going that kind of chronic illness route, right? That indemnity route. It's much easier for the carrier, but it's not always going to be easier or better for the client, which is why I think having these three solutions available through John Hancock is really valuable, right? Because you can actually tailor it to what is that client's long-term care plan to hopefully age in place for as long as possible without having to count on their financial portfolio to pay for it or their children to provide the care that might be needed to do so. And as we kind of wrap up, I want to just mention too, this is a rider that's probably available through every company. It's the Accelerated Death Benefit for Terminal Illness Rider. And this rider, I think it's something that's really important to keep in your back pocket, because if you think about a client who may have bought a life insurance policy, back when they were, 40 years old, and all of a sudden they're now maybe 50 years old, and maybe 60 years old, 70 years old, and they unfortunately get diagnosed with some sort of terminal illness, brain cancer or whatever it's going to be, they might need money now, right? They might need money now. The family might need money now to be able to help that loved one be comfortable where they are for what time they have left. And this is a case that I came across last year, and they were calling in. They had purchased I think it was PUL policy with the LTC rider. They called in to initiate a claim, and we're just starting the elimination period. But they weren't sure if the insured was actually going to survive the elimination period. So I suggested, why don't we look at adding the terminal illness rider to the policy? So it can be added at any point in time, which makes it very unique. So why don't we add this to the policy, It will give them up to 50% of their death benefit, up to $1 million on an income tax favored basis. So what we did was we added this rider. They had, I think it was a $250,000 death benefit. And we got them probably about $110,000, $115,000 in cash within a matter of a week. So that helped the family tremendously. I think the term they used was a godsend. It really helped them, because what they're going through at a time when, a mother or father or a child or whomever it is dealing with a terminal illness, I think a lot of people decide they want to keep that loved one home, right? And what kind of services can we bring in that's going to keep mom or dad or whomever it is at home where they want to be as they enter this stage of life. So it's a really important rider, and I hadn't talked about it all that much until this came up last year. It just really, I think, reminded me of how important it is. And I think when we sell life insurance, right, just the fact of selling life insurance, and when you look at some of these different riders we have available, it really expands that value proposition of life insurance in general, right? And I think that's what's really exciting about these products. It's no longer just going to provide money when somebody dies. It's providing money when somebody lives. And I think that is the most important thing to take away, whether that life is going to be short or long. This rider proved to be tremendously valuable for somebody who is at that kind of end of life stage. So something to keep in mind as you sell these products. So let's kind of wrap up. And I do want to put a teaser here for our last little puzzle piece. But these are the riders we kind of talked about today. Obviously, Vitality, this wasn't intended to be a Vitality presentation, but I do want to mention it. Obviously, it's our healthy engagement rider. It really gives customers that level of control over their policy. Like I like to say, whether they're buying a protection policy, accumulation policy, whatever it is, if they participate in Vitality, it allows that product to do a better job for them, right? So if they're looking to do cash value accumulation, have that policy perform well and grow over time to give them retirement income, like if they participate in Vitality, that helps juice up the cash value accumulation, right? So if they're healthy, they take healthy steps, they're going to have more income for when they live that long life. And I think from a protection standpoint, it's really helping them reduce the overall cost of the policy, right? They can actually reduce the premium they pay by participating in Vitality. So it is a unique value proposition to give a customer actual control, a lever of control over their policy and how it performs for them. So very important. And again, it's really in an effort to help our customers live longer, healthier lives. The rest of them are what helps them afford to live longer, healthier lives. So you'll see my little puzzle piece at the bottom here. This is probably the worst kept secret that John Hancock has had in the industry for the past year. And John's like, we have to do a teaser for that. I said, of course we will. So John Hancock, we're going to be re-entering the long-term care hybrid space. And so what that means for people who might not know the difference between hybrid and like benefit and riders and all that stuff, when you talk about an LTC hybrid product, this is one of those policies that is an acceleration of the death benefit plus an extension of benefits for long-term care. So it will be a 7702B rider. So it will be considered qualified long-term care insurance under the tax code, right? So if there's one of those opt-outs and they're only going to allow qualified LTC, hybrid products qualify, right? So that's one good thing. It checks the box for 7702B. We think, and of course we just filed this, we can't say a whole lot about it. We haven't got approval yet, but I'll just give you a little bit of a teaser. I can't even say the name if compliance will get mad at me. But it's, I think, going to combine the best of what we talked about today with using both indemnity and reimbursement together in one product, which I'm very excited about. And then lastly, the way we're structuring it is going to be something that will probably give us more opportunity to talk about some of those real tax treatment or tax favored treatment that some long-term care insurance products get to enjoy. So I think there's a lot to be really excited about. I know I'm very excited about this. We've done some testing with certain folks out in the field, and people are very excited. One, I think the product design they're very excited about, but two, I think just having the John Hancock name and company with our experience back into this market, I think is we're being welcomed with open arms. So I feel very good about hopefully being able to bring this to market sometime in Q1. So very exciting. Just waiting for approval from the states, minor detail, right? Approval, but then we'll be able to launch it. So I'm just going to move here for our friends in compliance because I like to stay on their good side. And then we can open it up to any questions that may come up. And I guess I'll turn it back to you, John, if you have any kind of closing thoughts, and then we can bring in Juniper if she has questions or if you have questions.
Okay. Yeah, that's Jen. Fantastic job. So that was so well done and so well laid out. So thank you for coming on with us today. If there are any questions for Jen, feel free right now to open up before we close. I'll give it a second if people want to raise their mic or raise their hand.
I'm going to stop sharing just so I can see.
Yeah.
If there's any. Okay.
Give people a second to ask if they have anything. Okay. Sounds like everybody's got it all. No questions. That's great. So anyway, and I think the takeaways here that I like to always impart in these is this is not about, we talked about our product and we went in depth, and Jen did a great job of that. I'm so glad we had that opportunity. But at the high level of it, for all of us on this call, no matter what our role is as an advisor or as a distributor like our friends at Capel or as a carrier like us at John Hancock, this is about conversations. This is really about getting clients to talk. Jen mentioned an example where the client said, well, my daughter's going to take care of us and they'll be there for us, right? And yeah, that's great, but that's a conversation starter. That's not a conversation. That's not a close. That's not the plan. So it's about getting people to talk about what is going to happen, how is it going to work, and what is the plan for that? Whether your family's involved or other caretaking, whatever it might be, please start the conversations with your clients. Okay, that's the whole idea. The second thing is, we talked about product and how important, all these great features are, and they are, but a product is not a plan, okay? And Jen will be the first to tell you as an expert, there has to be that plan coming out of those conversations. These products with these great riders that we offer are just the solution for funding, however you go, with whatever tax benefits come with it, or, however you design it, that's best for the customer. yeah, that's what we're going to do at the end of it. But conversations and planning are paramount to this. And we want to incorporate these into all the financial plans that are done. It's not just life insurance is over here and investments is over here. This has to be woven into the entire fabric of a financial plan. And I know everybody here, I think we all know that in our minds, but I don't think we can overstate it enough to be there. But other than that, and we're very proud to be with you. And again, with our product lineup and now the addition of our new hybrid product coming, I'm very proud, and our team is proud that we have probably, I would say, the most complete suite of living benefit solutions in the industry, as good as anything out there. So we're there for you there with our friends. You're working with our friends at CAFL, who can bring you to us and your customers to us, and to offer those solutions and whatever expertise or value that we can bring. So thank you for your time. Thank you for being on. Thank you, Juniper, and your team, as always. Appreciate the partnership, and we look forward to a great year end, and looking forward to what's coming in 2025.
Absolutely. Thank you so, so much.